Ladies and gentlemen, welcome. Welcome to the ESG conference for corporates, institutional investors, and banks, co-organized by the Institute of Finance and Financial Regulation and IBRD. We're delighted to join forces with IBRD once again for a second consecutive year. And we very much hope that you are going to find the conference very stimulating. The conference is going to run today and tomorrow, and we have composed a lineup of distinguished speakers. And we are very much looking forward to their insights. These are also joined by esteemed moderators, session chairs, and panelists. I would not like to delay you more. Before passing the floor to Andrea Moraru, the Regional Director of IBRD for Cyprus and Greece, may I thank our sponsors, the gold sponsors, Grant Thornton, Piraeus Bank, Protea Investments, silver sponsor, the National Bank of Greece, our affiliate organization, the Athens Exchange Group, our media partners, Athenea, Euro Today, Finance Pro, Next Deal, Οικονομική Επιθεώρηση, Greek Business File, and Savvy Investor. May I also thank Eventora, Hartis, and the University of Piraeus, and particularly the Department of Banking and Financial Management, under which IFFR is running. And may I also thank IBRD for the wonderful collaboration we have over these 2 years, and in particular, Andrea Moraru, Maya Henerkes, Olga Aristidou, and last but not least, the IFFR Marketing and Media Officer, Mrs. Despina Kondopoulou. So without further delay, may I pass the floor to Andrea Moraru. Andrea, the floor is yours. Thank you.
George, thank you very much. It's a pleasure to be here. We are very happy to organize this event with the Institute for the Financial Regulation and be at the epicenter of the most relevant discussions around one of the topics that is very close to our heart in EBRD. And this is to promote sustainable banking finance in the countries we operate. As probably you know, the EBRD has pledged that by 2023, we will align all our activities with the goals of the Paris Agreement and make more than half of our investments green by 2025. Paris alignment means achieving net zero emissions by 2050. Last year, already actually, EBRD achieved this target. 50% of our investments across our countries we operate have been in green projects. Financial intermediaries are crucial to deliver on Paris. However, the arm's length nature of the intermediate financing, combined with limited capacity of partner financial institutions to manage climate risk and exploit opportunities, present a challenge to align finance. This is also set against the fragmented external landscape of initiatives and lack of regulation in most markets. The objective of EBRD Paris alignment is to support the financial institutions we work in becoming more resilient to changes in climate and associated risk, and to improve their ability to finance low carbon transition. We'll prioritize our equity investments and key focus is likely to be on adoption of climate corporate governance practices, climate risk management, low carbon financing, and related disclosure. For the financial sector, the task is immense, and there are lots of challenges, but also this presents a unique opportunity. Massive amount and new financial products will be required to fund the transition to a lower carbon and inclusive economy, creating demand for financial products and services. Amount of financing needed to net zero transition is estimated to about 9.3 trillion euro per year. Banks that identify these opportunities can reduce their overall risk, become more competitive, and boost their returns. Mainstreaming ESG criteria in the financial sector is not merely about risk, it's also a vast opportunity for EBRD and its clients. We plan to be at the forefront of this shift and help our financial intermediaries clients to green their business and make their portfolios more resilient against climate change impact, ensuring a smooth transition. This can be achieved by investing in renewable energy projects, but also in construction of green buildings, investments in electric vehicles and clean transport, helping agribusinesses to enhance resilience against the impact of climate change. There is a growing momentum in the financial sector globally, recognizing the need to scale up efforts on climate. Climate change is becoming an essential part of good corporate governance in the financial sector, and of course, there is a clear push around disclosure of climate-related financial information. Financial institutions identify the regulatory environment as the most important driver in their decision to adopt climate-related practices in target. Regulators, not only in the European Union, but also outside the EU, are increasingly focusing on climate governance and risk management in the financial sector and setting expectations for climate and related disclosure. A significant part of EBRD financial institutions' portfolio is indirectly supervised by ECB and fall in the scope of this year's climate stress test. However, even for banks outside the regulatory sphere of the EU, pressure will be mounting. Regulatory spillover will impact all our region, and investors will be looking at ESG criteria more closely, especially in the context of equity investments. In this context, greening the financial sector is central of importance for us. And what does it mean for our business in the financial institution sector? So going forward, we'll have to have meaningful discussions with clients and regulators on climate risk for banks, climate corporate governance, as well as transition planning. Advise our clients to scale up their green finance and align their financial flows with the Paris alignment, and implement certain due diligence process approval documents to take climate-related risks and opportunities into account. But where is Greece on the green agenda? Greece has one of the most ambitious decarbonization agenda on all of our countries of operation, and we are very committed to support this implementation. We have advanced our sustainability agenda in line with our strategic priorities in the countries that are mainly to strengthen the competitiveness of and the expansion of the private sector, to support sustainable energy and infrastructure, including through further regional linkages, and further to enhance the resilience of the financial sector. Of course, the advent of the pandemic, as well as the recent events in Ukraine, undoubtedly require the inclusion of additional measures in response to the crisis and efforts to support economic recovery. Last year, EBRD has invested in Greece 840 million euro in projects across different sectors. 52% of these projects were green, and I'll just mention just a few of them. We participate in the capital increase of the Public Power Corporation, which will enable the company to accelerate its expansion into renewable energy, digitalization, and e-mobility, and also support this privatization. We've been very happy to support the green bond of Mytilineos, 500 million euro benchmark issued on the international market. We have also invested in equity in the Meridian Sustainable Infrastructure Europe. This is a private equity fund aimed to promote a more widespread use of private ownership in infrastructure projects, and thereby contribute to the resilience and infrastructure sector in EBRD countries of operation. With PPC, also supported their inaugural sustainability bonds. These are the first this type of structures to include sustainability as part of their features in all our countries of operations. We also participated in the green bond of Noval. This is a first-time transaction for the company on the Greek capital market. We have also worked with the banking sector. We supported umbrella issuances of both Eurobank and Alpha Bank, and both structures, for both structures, the use of proceeds for EBRD project. Together with demand, we invest in the development, deep refurbishment, and regeneration project in Greece in various sectors. Our joint venture integrates sustainability and climate resilience, investing in green certified assets. So far, we invested in flagship projects like the transformation of the former Papastratos industrial facility into a modern office space, the revival of Piraeus Tower, and recently the newly completed Moxie Hotel in Omonia. We have also worked with Prodea, and we provided 50 million financing to support green assets. In the last couple of years in Greece, we have witnessed a shift of focus by our clients toward more sustainable investment. Both investors and users realize more and more that green investments encompassing climate resilience technique extend both the lifetime of the assets and makes them more resilient. Resilient both environmentally but also financially, as green buildings imply lower operating costs as well as better usability of the spaces that has an impact of the productivity of the users. ESG performance is increasingly used by the stakeholders to draw conclusions about the quality management in identifying exposures to business risk and leveraging business opportunities. Therefore, it is becoming more and more important for companies to communicate with investors clearly and accurately with these aspects. There is a growing evidence that companies that publish high-quality information on the longer-term implication of ESG in their business are more likely to attract long-term investors and reduce the cost of capital or increase their ability to finance sustainable projects. We are promoters of more activity in both debt and equity capital markets, as some of the examples I mentioned before, and we are particularly supporting green issuances, including green or sustainability-linked bonds. Separately, we also aim to promote investments through Recovery and Resilience Facility. RRF is at the heart of Next Generation EU, and it has a big overlap with the focus of IBRD strategic priorities, which are not limited to green transition, digitalization, inclusion, and innovation. As such, we are actively engaging with investors in the sector and the Greek authorities to finance projects on the RRF. IBRD has signed a contribution agreement with the Greek government last year, and we are managing $500 million of the RRF funds that are matched by the same amount out of own sources. We strongly believe that the targeted use of the RRF funds will help Greece emerge stronger and more resilient from the current crisis. We're happy to see that Greece is a front runner in securing RRF funds flow, and we hope to prove a front runner in the successful utilization of these funds. As a final note, I would like to mention that we plan to support even more green investments in Greece in the years to come. I really hope that this event will ignite further dialogue between EBRD investors, operators, and policies. Such events are very important for us as a means of identifying how and where we can best focus our efforts to further support the push and push the ESG agenda, both in terms of investment and technical support. So again, a very big thanks for the collaboration with the Institute of Financial Regulation for this event. Thank you.
Thank you, Andrea. Before introducing Dr. Elizabeth Filippouli, the chair of our next session, let me very briefly state two remarks on the logistics and structure of the conference for those of you who are not familiar with our past conferences. So the program is a mix of structured presentations. So these are the regular sessions, as we call them. So each session has 3 speakers and the session chair. Each speaker will have 15 minutes. And at the end of the 3 speakers, we're going to have a 30-minute Q&A with the audience. So feel free to submit your questions through the Inventora facility. And in addition to these regular sessions, we're also holding at the end of each day a roundtable panel with esteemed moderators and panelists. So we have a mix of highly distinguished academics and professionals, and this is very much in line with the objectives of the Institute of Finance and Financial Regulation, which is an international research center and which aims to bridge the gap between cutting-edge academic research and the needs of professionals. So without further delay, let me introduce Elizabeth Filippouli, who is going to chair the next session. So Elizabeth, we're delighted to have you with us. Elizabeth is very well known as a journalist, both in Greece as well as internationally, since she has also worked for Al Jazeera and CNN. And she also has a very interesting background and professional expertise, because in addition to her activities as a journalist, she's also the founder of Global Thinkers Forum and Athena 40. Global Thinkers Forum is a very interesting initiative which has been founded under the patronage of Queen Rania of Jordan. And Elizabeth is also a very prolific writer. Her very recent well-known book is From Women to the World, Letters for the New Century. So Elizabeth, we're delighted to have you with us, and the screen is yours. Thank you.
Thank you, Professor Skeropoulos. Thank you, George, and good afternoon, ladies and gentlemen. First of all, I would like to thank the Institute of Finance and Financial Regulation and IBRD for hosting this very important and timely event, and of course for inviting me to chair this session as part of the annual ESG conference. As George mentioned, my name is Elizabeth Philippouli. I'm a social entrepreneur. I'm the founder and CEO of London-based Global Thinkers Forum. It is an independent civil society agency which was incubated at Said Business School of the University of Oxford 11 years ago. And our work is to bring together a global network of thought leaders who promote partnerships and values-driven leadership. Athena 40 is our initiative that supports women's empowerment and female leadership. My most recent book, as very kindly George mentioned, the title is From Women to the World, Letters for a New Century. It was published last year. It is very much a work that shines a light on purpose-driven lives of exceptional women from around the world. And the reason why I wrote this book, which is more of a project really, is because I believe in the importance of leaving a legacy behind. So to me, it is very much about embedding that idea of doing well by doing good, which I think very much this conference today is also driven by. Now, all of us have been living through an ongoing crisis over the last 2 years, longer than that, really. It's the complexities and challenges that have created those challenges and are calling for a response on our side, which is not going to be soft in nature. A crisis means blending the need for immediate response with long-term planning and thinking, strategic thinking. It is also about balancing the need for immediate priorities and also holding space for tensions that, as we have seen, arise in our world out of the blue. The prospects of the world's future, unfortunately, is fraught with difficulty, but there is, of course, opportunity out there. But we do have some challenges ahead, which have been brought about by the pandemic, now the war in Ukraine, and of course, the shifting economic conditions around us. And we see the accelerating effects of climate change and the enduring and deep-seated inequalities. Now, governments around the world have been committing, and quite rightly so, significant resources to foster the channeling of private finance towards sustainable investing and sustainable solutions for our societies. And that is said to become even more mainstream. And this is what makes this conference today all the more timely. Our environment, our ecosystem, our sustainable present, and our sustainable future for the future generations, and also ethical and values-driven governance are of growing importance. And ESGs, of course, have evolved into a field for partnerships and collaborative projects, collaborative leadership, driven by the idea that we must prioritize stakeholders rather than shareholders. Now we're going to hear from 3 international experts today. And so I would like to invite John Wilson now to be our next speaker. John is the Executive Director of Corporate Engagement with Calvert Research and Management. And John, you're responsible for overseeing Calvert's systematic top-down monitoring and bottom-up research approaches to identify issuers where dialogue and critical environment, social and governance, of course, ESG topics could help improve long-term corporate value and environmental or societal outcomes. John began his career in the investment management industry in 1997, and before joining Calvert Research and Management, he was head of governance and research at Cornerstone Capital Group. Now, the push for building a more sustainable economy, John, has relied significantly on the public sector and public sector initiatives, but much of this change, of course, investor-driven, and I know that you now have the task of explaining to us how investors' trust can be earned so that they put their money in worthwhile projects. Over to you, John.
Oh, thank you very much. It's a pleasure to be with you, and I'm glad to have the opportunity to talk about corporate engagement with this audience, and really to talk about the trends that we're seeing in how companies and shareholders relate, because I think the point that Professor Edmonds made about the growing of the pie is so important, and it's something that we as investors share, the desire to do that. Number one, because it helps our returns, and number two, because we believe that building a better world also creates a more sustainable set of financial markets for us to invest in over the long term. And in addition, our clients care very deeply about the issues such as climate change and diversity, which we'll talk about. So corporate engagement is really the process by which we help to grow that pie by our discussions with companies. And I want to thank Professor Edmonds for explaining what a shareholder proposal is, because I want to talk about that. That is a very important tool that we use in our engagement with companies to try to foster better and stronger thinking and action on such issues as climate change, diversity, and human rights. So what I'm going to do is I'm going to share my screen and talk a little bit about the trends in shareholder proposals. Then I'll talk about how what kinds of things we want to talk about with companies, and then I'll finish with a couple of examples if we've got time. So let me share my screen right now if I can. Okay. All right, can we all see that?
Yes, we can.
Oh, terrific. Okay.
You don't see it yet in screen mode. Now it's in on-screen mode. Lovely.
Oh, okay, was that better the other way? I apologize.
The previous one.
Better? This one?
That's it.
That's it.
Yes.
Okay, terrific. Thank you. Sorry. Technology is not my expertise. Anyway, I want to talk firstly about the trends in filing shareholder proposals, because again, this is a sign of the activity of shareholders to try to change corporate behavior. And we can see that actually over the last several years, since 2019, the number of shareholder proposals has increased, which implies, I think, an increase in interest among shareholders in this kind of engagement of working with companies. But if we drill down a little bit more, what we see actually is a little bit more of a nuanced picture of this process. So if you look at the top left, you see the types and number of climate change proposals. These are mostly these days on carbon asset risk management, and they've been increasing in number since 2019. So that implies that more shareholders are pushing companies to take a greater stand on climate change. But if you take a look at the right-hand side, you will actually see that the number of proposals that actually appear on ballots have declined. They're actually at historic lows. And that is because shareholders and companies have been reaching agreements about the proposals before they come to a vote that allow the shareholder to remove them from the ballot. And that actually represents something that shareholders prefer. They prefer to work out these kinds of issues with companies in private dialogue rather than having a public proposal. So this is actually a sign of success. You can also notice, if you look at the purple line on this chart, that when shareholder proposals do come to a vote, we've seen a significant increase in support. And in fact, in 2021, for the first time, the average climate change proposal received more than 50% support from shareholders. Now, this is actually one of the reasons for this is that some of the largest shareholders in the world, including BlackRock, which I think we all hear about, have started to support these proposals. They went from about a 10% of proposals they were supporting to about 30% if we look at the largest shareholders as a group. So there's been an increasing amount of support among larger shareholders, and among all shareholders, a much increased in activity. If we look at the diversity as another example, we see again an increase actually in diversity proposals through 2021, and then a decline actually in 2022. And that results from the fact that so many of these proposals were accepted and so many companies are actually taking action. And so the decline is actually a sign of actually increased collaboration between companies and shareholders. And if we look at the right, you'll see, in fact, the orange line shows the number of proposals that have been withdrawn, again, because companies and shareholders have achieved agreements. And so that number has actually spiked over the last couple of years, again, because of the willingness of companies to work on issues like diversity. So what I want to do now is, I'll say is that while these signs show a lot more kind of collaboration and collegiality and constructive dialogue among shareholders and companies, there are issues also. And one of them is the perception that a lot of ESG is greenwash. And if you read the news lately, for example, the CEO of a very prominent electric car company has been making this case pretty loudly. And if you look over a longer period of time, the term greenwashing has become much more prominent in Google searches. So this is a sort of a superficial data point, but it kind of points to an increasing concern among many publics that ESG is really just window dressing, it's for show, it's not substantive, okay? And we see that both in our relationships with the regulators who are asking us much more detailed questions about our processes for integrating ESG into our investing, as well as from our clients who, again, are really asking very probing questions to us about, well, is this real? Are you actually doing it, and are you having an impact? So those things are very important. Now, as Calvert, we're very happy to receive those questions because we've been doing this for 40 years, and we've believed in ESG both as an investment strategy and as a strategy for impact for a long time. And so we have what we think are good answers to those questions. But it shows that really what's needed in shareholder engagement is a much deeper engagement with companies to make sure they are not simply just making commitments, but actually they're delivering on those commitments as well through their operations. So what I want to do now, as we move forward, is to offer a simple framework that we use to talk to companies and talk about the issues. When we talk to companies about issues, what is it that we're actually asking them to do? And so this is very simple, but just sort of a high-level explanation of what an engagement might look like. So the first piece of successful substantive engagement that convinces us that companies are ready to execute on their ESG commitments, number one, is the idea of materiality. So firstly, does the company see ESG both from a framework of impact and as a framework for building a prosperous company over the long term? So something we call double materiality. That's a term many people should do know. The second piece is strategy. And what we want to see in the company's business strategy is consistency with their ESG strategy. So when I read the sustainability report, is it consistent with what I read in the proxy materials or what I read in their financial statements or their management discussion and analysis? Is the company's sustainability strategy visible in its business strategy? Moreover, if it's involved in public policy, are public policy strategies also consistent with the business strategy and with the ESG strategy? So is the company purpose-built, in everything that it does to achieve on ESG? So we may be looking at CapEx, we may be looking at R&D, we may be looking at spend on payroll. All of these kinds of things tell us whether the company's commitments to ESG are reflected in its actual business operations. The third thing we look for is competency. So is the company well positioned to act on its goals? So firstly, is the board inclusive of people who have the skills to oversee what the company is trying to do, right? So if you have a strong climate change strategy, but no climate expertise on the board, that's a concern, right? We also look at human capital management. How engaged are the employees? What's the turnover like? How diverse is the workforce? Is this a workforce that's built for innovation, right? And for attending to all of the issues that stakeholders may be feeling, right? And bringing to the company, does the workforce, are they ready to handle those issues? The fourth piece is impact. And is the company, do they understand what their impact on stakeholders is, and are they measuring it? And part of the strategy, if you will, for purpose-driven companies is actually measuring the impact that you want. If you don't have it measured, you don't know whether your strategies are achieving that. So that's something that we look for also. So it's not just financial outcomes, but it's also social outcomes as well, measured in objective terms, so that it's not simply the company kind of marketing itself. And then finally, accountability. Who is responsible for this, right? Who is in charge and how are they held accountable? So what about compensation? Or what about, where is ESG placed in the company? Does it report to the CEO? Does it report to the board? Or is it kind of often in a place where it won't have a lot of impact on the company? So that's kind of an example of the sorts of questions or the sorts of things we want to talk to companies about, so that we get beyond simple commitments to ESG to the substance that allows innovation and continual improvement in the company's impact on society. Okay, a couple of examples of what I'm talking about or how engagements might unfold. So the first one is having to do with the Task Force on Climate-Related Financial Disclosures. Many folks have seen this, probably familiar with this table. This table tells you how many or what percentage of companies are reporting their climate strategies and in different aspects of their climate strategies. And the first thing that pops out at you is something that's very positive, which is over the last few years, the number of companies that have been doing TCFD reporting has been increasing quite substantially. And that is in line with what I was talking about earlier, which is there are more agreements between shareholders and companies about this issue. But looking at this table a little more closely, you see that different types of reporting are being handled by different numbers of companies. So for example, 52% of companies are reporting on their risks and opportunities. 44% have climate metrics. 34% have climate targets, right? So actual operational goals. 29% have risk management processes. 25% have board oversight, and 18% have management roles described. And so what we see is that the ability to talk about the risks and opportunities is much more common than the actual assignment, for example, of this issue to leadership, and much more common than actual having processes and goals. So the execution is less common than the acknowledgement of the issue. And that is what shareholder engagement is meant to get at. It's, okay, you've acknowledged these risks and opportunities. Now, what are the operations? What's the leadership to make sure you're handling those effectively? That's, I guess you can say it's a work in progress at this point. Okay. Last one, and then I'll be finished. So this is diversity disclosures for U.S. companies. So just to explain for those who might not be familiar, the EEO-1 report is a required report of all U.S. companies that they send to the U.S. federal government that details their workforce demographics. So by gender, ethnicity, and job classification, how many people are in each category in the company. So it's a great tool for understanding workforce demographics and how diverse a company is. The problem is that the EEO-1 report is submitted to the government but not made public unless the companies want to do that. And you can see that in 2020, that very few companies, 20 out of the top 100 in this case, were publishing their EEO-1 reports. That year was the year that George Floyd was murdered, and in the US we had lots of racial justice protests. Many companies made commitments to supporting the Black community within the United States. And so many of us shareholders went out and said, if you're going to make those statements of support, you have to back it up. And you need to back it up in part by releasing these reports, which help us to understand what your workforce demographics are. And you can see that this has been a successful campaign. By 2022, almost all of the companies in the top 100 are releasing their reports, and more broadly, about half of the S&P 500 companies are releasing their reports. Now, this is important because companies have been providing diversity disclosure for a long time. But honestly, if you read diversity disclosures prior to this, all companies were above average, right? They were all presenting kind of the best features of their diversity program. This is objective, comparable, consistent information. And once you have it, a much more nuanced and realistic picture emerges. And that is, most companies have problems when it comes to diversity. Doesn't mean they're bad companies. It means they're on a journey. And we want to work as shareholders with these companies to improve upon that. I'll give you one example. There's a company that does pretty well on diversity among its professional staff and among its leadership, but its sales force is 70% white men. So the face that it presents to the world is not a diverse face, even though in itself is a reasonably diverse company. So that's an issue that the company needs to work on. The EEO1 provides us, because of the accountability, provides us with a means to talk about those issues and eventually start to get ahead of them.
John,
so that's really, yeah, go ahead.
I have to cut it short. Have you concluded your presentation?
I'm done, so we're fine.
Okay, great. I don't want to be, rude here, but I
Nope.
need to, have orders to stay with timings here. But you made a fantastic presentation, a very insightful intervention here, and disclosing information on ESG-driven actions. I think it's necessary, and I believe that the European Commission last year launched a legislative proposal for a corporate sustainability reporting directive, which expands that requirement to publish non-financial information and sustainability information in specific to a much larger group of companies now. And this takes us to our next speaker. Thank you, John, and thank you, Professor Edmonds. We're going to come back to you when we have the live Q&A. Our next speaker is Natasha Kazanov, Executive Director of the European Securities and Markets Authority, ESMA. Natasha was previously Managing Director in charge of the Policy and International Affairs Directorate at the French Autorité des Marchés Financiers. She has worked for a European consultancy specialized in corporate governance and the promotion of investors' rights. She started her career in the valuation and business modeling team of Ernst & Young, corporate finance. And Natasha Kazanov holds a master's degree in economics and finance from the University of Paris Dauphine. Natasha, welcome to the conference today. Your topic is going to be about regulation, the present and the future of ESG regulation.
Yes, thank you, Elizabeth, and thank you to the Institute of Finance and Financial Regulation and the EBRD for the invitation. It's really a pleasure to be here and a pleasure to intervene after these two eminent speakers, because I thought they were very insightful presentations, and I hope that mine can be complementary to what was said before. Clearly, what was said, we're talking about the shift to a more sustainable economy, which is a generation challenge and really clearly a long-term project, and how do we go about it? So as a representative of the European Securities and Markets Authority, I'm going to try and share what is the perspective from the regulatory framework, what can we do as financial supervisors of the financial system in the EU, and how the framework can try to contribute to this journey. I will focus on the framework with three angles. Bear with me, please. First, to start with the corporates and what has been done and what is in train for corporate disclosures on sustainability. Also to try and consider what impact this has for other participants in the system and how that is used, notably focusing on ESG rating providers and also on financial market participants more generally, and then trying to say how ESMA is trying to contribute and help corporates navigate through this journey. Let me just share my screen so you can follow me through this presentation, hopefully. There we go. Okay, so as you know, so for the European Union, this is really very high on the political agenda. Sustainability, making sure that we make the right decisions, the political decisions, and very strong commitments have been made by the European Union to be through the Green Deal and those projects to try and reach for 2030 a reduction of 55% of emissions and to be climate neutral by 2050. And to make these commitments real, this has translated into very hard regulation to make sure that the system functioned. And what I would like to do today is really focus on corporates, because they are at the very heart of the system, actually. And it has taken us a while in the EU to really focus on them properly. just at the outset, just to focus on this, to explain a little bit the context, is when we look at the figures, we can see as we monitor the developments, the demand is very clear. And I think also from previous speakers, we can see the maturity and what exactly the expectations is has also moved on. We see if we look at the European market, for example, for green, social and sustainability bonds, they stood at 1.2 trillion euros at the end of March this year, and that's an increase of 50% compared to last year. If you look at assets that are managed by EU domiciled ESG funds, they also grew by 20% over the same period to 2.1 trillion. So we see that the demand is very strong, and so there's also an obligation to make sure that we make due to the promises and we're clear what exactly is behind. And for me and for us, corporates are really at the core. They are at the heart of the system because at the end of the day, if we want to make sure we make this shift, we need to understand what is happening in the economy itself. If you look at the corporates, if you, at the lens from the corporate perspective, you can see they are confronted with two types of challenges. On the one hand, the pure compliance, which is because the EU is so ambitious on this agenda, how do they make decisions so that they can actually deliver on these commitments and they can be compliant with the European climate policy targets? At the same time, they also, because climate change is real, have to build their own resilience towards these changes and make sure that from a risk management and operational business model perspective, they adjust. I should also say here, it was mentioned also just before by the previous speaker, there is also very strong pressure from shareholders. So there's also an expectation from the shareholders of companies that some of these decisions are made. Again, corporates really at the engine of the sustainable investment chain, a very determining factor. This also has an impact, as Andrea said in her introductory remarks, on funding opportunities. More and more, and this is what she mentioned, has been demonstrated that if you want to obtain long-term financing, more and more banks or even market-based financing, you will have expectations that you have to demonstrate how you are going about on this journey. So this is also very real for companies to be able to finance also their investments more long-term. All this means we need to make sure we can provide the tools to allow firms to be able to define what their sustainability profile is. And this is really in the making today. If I move now to the next slide, how is the European framework going about this? And the way the European framework is designed, it actually looks at different parts. It looks at the core business of a corporate, what we call here products and services. It looks at the governance, so more from the accountability perspective, and it also looks at the stakeholders at large. And as you mentioned also, Elizabeth, in your comments, it's not only shareholders clearly here, we're also talking about local communities, the value chain upwards and downwards, and of course the employees. When we look at the different regulations, the Taxonomy Regulation is the one that is designed to try and help firms communicate on whether or not they are aligned with the trajectory and the Paris Agreement. I will come back to that in a minute. In particular, we mentioned Article 8, which is an article which is a requirement for corporates to be able to communicate on KPIs, so key performance indicators, to provide that information to the market. And it's information on turnover, on CapEx, and operational expenditure as well. I'll come back to that in the next slide. Then we also have the non-financial reporting, and as you very rightly said, we are moving now from the non-financial directive to a much more ambitious framework with the corporate sustainability reporting that I will also come back to in a minute. And the last one we wanted to mention here is a more recent initiative that focuses on due diligence and what are we expecting also from the directors and their own duty to monitor and make sure that there is a proper due diligence process in how firms meet their expectations and commitments. As ESMA, as a securities regulator, we're very conscious that this is a complex and long-term journey, that the implementation challenges are very real, and we try in our engagement with the firms to provide some clarity, both from a reporting and accountability perspective on how they go about this. But please also feel free to comment on the various consultations. It's also very important for us to make sure we understand what the challenges are on this important journey. I'm going to dive 2 minutes on the Taxonomy Regulation, just because, again, this is the regulatory framework, and in the EU, we're going about this with a very high ambition. We're trying to translate it into practical commitments, and this goes through regulation. But because this is a very long-term, complex shift of the entire economy, we're very conscious that this is, despite the political will, you actually need these regulations to operate the shift throughout the system. But also we see that despite the strong political will, this is where we are. There was a study that was conducted by the Commission's Joint Research Center that has shown that in 2020, only 1.3% of investment portfolios were taxonomy aligned. This is very low if we share with the ambition and the ability for also firms to raise funds and to deliver on the expectations of shareholders that want to investee firms that actually deliver on these commitments. Why is that? First, because the taxonomy is for the moment incomplete. It's a step-by-step process and we're iterating. We only covered climate change mitigation and adaptation so far. We still need to go for biodiversity, pollution, water, resources, etc. And also because the transition effort had not been covered until now. The platform on sustainable finance is working on that to try and provide some clarity on how could we capture transition pathways, because that is actually the most difficult part of the journey, is to shift the economies and the business models to this new world where we want to be more sustainable. Taxonomy disclosures are also very complex, precisely because the data is not there. The corporates themselves need to make sure that internally they are able to have processes and procedures to analyze and be able to assess and then communicate in their publications to the shareholders, to the market at wide and all stakeholders, what exactly what their journey is and the different milestones with concrete data. And that data also is missing today. We have tried to contribute with a number of guidance and publications to try and accompany the firms on this journey. Corporate sustainability reporting, as I said, a game changer from the non-financial reporting directive, move for larger scope, now mandatory standards and a mandatory assurance. So hopefully now we're also moving towards this requirement, which will give a much more comprehensive and strong framework. What is specific in the European framework, it covers double materiality, so the impact of climate change on the firm and its activities, but also the impact of the firm's operations to the environment. Comprehensive coverage that is not only the environmental, but also the social and governance impact, and also the necessary consideration has to be taken for internal governance and controls. This is very ambitious, more ambitious than other parts of the world. That's why there is a very also strong challenge collectively to make sure we can also provide globally consistent responses to these challenges, working with colleagues throughout the world. And here ESMA will have to issue recommendations on the standards from an accounting perspective that EFRAG, the European Financial Reporting Advisory Group, is preparing to help firms in their reporting on the sustainability agenda. On corporate ESG data precisely, this is what I wanted to mention, is it's so important, the corporate information, because in the investment, sustainable investment value chain, it's the corporate information that then flows through the system. And I just wanted to mention very briefly work that we've done. We've focused on credit ratings and the extent to which credit ratings gradually are incorporating ESG factors. To the extent that they are considered, we will require them to be disclosed. And also importantly, I will just skip quickly on this one and focus on ESG ratings, because again, in the value chain, if shareholders want to be able to vote or approve or adjust their investments based on the journey of the firm, they need to have that information. And until we get the information from the CSRD, then there are also some firms in the system that are using the data available and providing data to the market. And today we can see the growth in demand is increasing, but the diversity of the proposal on the market is a bit worrying. And we've been calling for more transparency, reliability, and independence. Why is this important? A point that was made earlier, to avoid greenwashing. It is very important that the information that comes out is reliable and transparent in this journey that we're all going through, which is transformational for the market. We need to make sure that the information is robust, and there is a significant risk that we lose trust in the system if there is a misalignment between the promise that is made by the firms or the fund managers or banks and what actually the investors see at the end of the day. And that's why a proper regulation, a proper framework for ESG rating providers is so key. Similarly, in the SFDR, which was the first regulation to come out in the EU on disclosures from financial market participants, there's been incrementally a number of requirements out there. I'll just mention one point. It's extremely important here also, when financial market participants put on the market products, they are mindful of that trust that we need to maintain in the system. There are requirements out there, but also some freedom, of course, for firms to decide what name they want to be there. The SFDR, is really built on transparency requirements. And what is really important is to make sure that when you provide, for example, a name of a fund that says climate change, that it's not just 5% of the portfolio that is actually going to make a difference. And today we're still in the middle of that journey, and SFDR provides more of a transparency angle. And what we see is a bit worrying today is that it's being used more and more in the market as a labeling tool, and therefore, even more than before, we see as a very high priority with all national competent authorities across the EU to make sure we can combat greenwashing and make sure that whatever is promised to the investor is aligned with the actual investment products and what it can actually deliver. And on this, we've been publishing a number of guidance, and we will continue to do so to make sure that the investors actually receive the products that they wanted. Thank you very much for your attention.
Thank you very much, Natasha, for excellent timing of your presentation. I would like to invite our audience to submit questions, because this is very much about making a conversation that is interactive. It's a fantastic opportunity to communicate and raise questions with, among three global experts in that field of ESGs. So please keep submitting any questions. We now have 29 minutes to cover, and please switch your cameras on, John, Natasha, Alex. I have two questions for Professor Edmonds. One of them goes, can the idea of making the pie bigger be applied to small businesses? And the second question for you, Professor Edmonds, how can SMEs succeed in ESG terms?
Thanks for the questions. I think these are really important ones, so that's what I was hoping to get to at the end of the presentation. So I think this is why it's really important to view purpose as growing the pie, not redividing it. So if purpose involves redistributing the pie, then only large companies can do that, because it's only them who have pie to give. Right? In the pandemic, we saw Unilever spend 100 million euros in food and sanitizer. That is great, but that's sort of quite sort of scary to a small company that really can't do that. But instead, if you think about purpose as using what's in your hand, that's something that all companies can do. So the example that I was going to give was of this gym. And so what it did was it offered free Zoom fitness classes or Instagram fitness classes, which made a huge difference to people self-isolating at home. Now, you might think that you don't need some special mindset for a fitness company to offer fitness classes. That's kind of obvious. But what was the great thing is what the desk workers of the gym did. Right, so the gym was closed, so there was no desk work to do. But what it turns out is that many of these desk workers are actors as their main job. And if you're an actor, what is in your hand? You're really funny. Well, how does being funny help in a pandemic? Well, what we had was a lot of schools were shut, so children were at home, and so that was really difficult for working parents. And so what they offered was free Zoom storytelling sessions to these children to take the load off their working parents. So I think if we're thinking about using what is in our expertise rather than spending money, then I do think that's something for SMEs to do. So thank you to both people who asked that question, which I think is really important for this being something which is not just for big companies, but for all companies.
Thank you very much, Alex. The next question is about rating agencies. How will the investment approach consolidate itself in regards to the integration of ESG factors, given the profound divergence of ESG assessment carried out by rating agencies? Who would like to go first with this one? John?
I can take a stab at it, and of course, I can't speak to all ESG investors. I can only speak to Calvert. We don't rely on ESG ratings from outside vendors to make our investment decisions for us, right? So our approach is we actually develop our own internal key performance indicators. We look industry by industry to see what the most material factors are. And then we develop a quantitative model for kind of an ESG evaluation of a company that is then also supplemented by the judgment of the analyst. So it's actually a fairly robust process that we have internally that relies both on qualitative factors and quantitative factors to make the kinds of decisions that we have to make. So we don't really rely on rating agencies, and I think that that's probably where things are going for a lot of ESG investors.
Thank you, John. Natasha, any thought here? And then Alex?
Yes, happy to chime in on this one, because I think what's very important is to make a difference between what an ESG rating is and a credit rating is. A credit rating is just a credit rating. It assesses the credit worthiness of the firm. We have seen more and more credit rating agencies incorporate ESG factors into that, but to the extent that it's material for the credit assessment. And when that's the case, we ask them to disclose that so it's clear for the investors. Separate from that, you have ESG ratings. And that's where I was saying we see a very big diversity in terms of what's produced. And sometimes for the same firm, because the methodologies are so diverse, you would end up with very different results, because somebody's going to use the governance factor a bit more, the other one is going to be the environmental one. So I think in this area, what we're lacking today is transparency. So there's more understanding. And then, as it was just said, that you just then pull the information, and depending on what your investment strategy is, you can then use whatever rating you think is the most appropriate. But today, we don't always know how these ratings are designed, and there really needs to be more transparency and regulation around conflict of interest.
Alex, you wanted to chime in here?
Yes, thanks, Elizabeth. I actually think that the inconsistency of ESG ratings is really good rather than bad. Like, people lament that this is a bad thing, as if they should be completely homogenous. But the word that Natasha mentioned was diversity, right? You've got a variety of opinion, right? It's opinion is that's what an ESG rating is. Nobody would say Morgan Stanley and Goldman Sachs equity research is unreliable because somebody says buy and the other says sell, right? They have different views on this. And so what you need to do as an investor is not just take the rating off the shelf and follow it. You would read the underlying arguments, just like you wouldn't take a buy or sell recommendation. So what John describes at Calvert is exactly what we do at Royal London Asset Management. We'll use it as an potential. So there's some really nice academic research which just came out in the Review of Finance, the journal I run, which looks at the reason for the divergence, why it's short blog about it on my own blog for a practitioner audience. And so that was, I think, a really good deep dive into the cause of the differences and why this is actually not too much of a problem.
Thank you, Alex. So the next two questions are for John, but I think it's important to have everyone's insights here. If you feel like, contributing your thoughts, please go ahead. So this one has, quite a few questions here. Does engagement have any real effects on the operation of the company, or is it just ticking a box exercise, which is what we have been discussing really? What if a company does not comply with proposals via engagement? Will you ever divest from the firm? And even if you do, will this divestment have any real effects? The second one, how do you deal with greenwashing and the diversity of ESG ratings across raters? I think we've just addressed that. Do you construct internally your own ESG ratings?
I'll take the last two first. I think the answer is yeah. Do we construct our own ESG ratings? We don't call them ratings, right? And it's important to understand that this is an investment decision. It's multi-factor. It includes fundamental factors as well as ESG factors, some of which are quantitative and some of which require the judgment of the analyst. So I wouldn't say we have ratings. We do have information that we generate on each company. So that's that. In terms of greenwashing, I think it's a very critical point. And I was, maybe I could stress what I was talking about earlier, which is the purpose of engagement is to try to get beneath the greenwash that may be happening, right? A company may be making great statements about ESG. What we're interested in is their capacity for execution. Are they going to be able to deliver on the commitments, or are their operations going to be consistent across the board with what their ESG commitments are? Now, the question is, does it have any effect? My experience is, and I've been doing this now for 25 years, that there is significant impact over a long period of time for engagement, and sometimes in short periods of time. So, for example, we talked about the diversity reports that are coming out right now from companies. 10 years ago, the idea that diversity was a business issue was a fringe idea, right? It was investors that brought these issues to companies to say, you need to think about diversity as a key management, an aspect of good management, right? A diverse workforce is, will perform better overall than a non-diverse workforce, all other things equal, according to the studies, right? That was not a common idea 10 years ago. Today, it is a very common idea. And it is partly because shareholders brought that to the attention of companies. You can also see it in very small ways, in the ways that companies have been developing net zero targets. That's also something that shareholders have been asking for a long time. And as I said, the next stage is, okay, you made the target, how are you going to deliver? So anyway, I got to talk about that for a long time, but that's basically it.
Thank you, John. Who would like to contribute?
I'm happy to pick up on engagement. So I think in many cases, engagement does improve outcomes for both shareholders and stakeholders. There's a lot of nice academic research on that. So the research by Caroline Flammett in my talk is supportive of that. However, the research is not completely unequivocal, because sometimes there might be investors who engage not to improve long-term value for either shareholders or stakeholders, but to improve their own reputation. So if an investor makes a lot of noise and says we're going to engage in all of these issues, you can get a lot of fund flows coming in. And there's a very nice academic paper which looks at gadfly proposals. So these are investors who don't really have a lot of skin in the game. They will take their particular bee in the bonnet issue and apply that to every company, irrespective of materiality, irrespective of whether the company is already handling it well. And so what this finds is that if you are a non-gadfly investor, so this is the purple, right, you typically find the positive long-term returns to the engagement. But if you are a gadfly, you find long-term negative returns. And so this is really useful, because then you have some shareholders who think about, do I want to support a proposal? And sometimes as the media, we say, oh, you investor, you claim to be sustainable. Why are you not supporting one of these proposals? But I don't think it's as easy as that. The Norwegian Sovereign Wealth Fund has one framework to think about what to support and what not to. Is it material? Something that both John and Natasha was emphasizing. That's not to say this is the only possible framework, but just to say we should have a framework rather than thinking that engagement is always good.
Mm-hmm.
If I can just add a few things. I wanted to talk about greenwashing, if I may, Elizabeth. This is a very high concern for a number of authorities, at least across the EU. And their concern is because of this very strong demand and the speed at which product ranges are being shifted and ESG becoming mainstream. On the way, there is a risk that there is a disconnect between what exactly the product is offering and what is possible. And because the data is missing also, it's actually even difficult for very well-intended players to actually propose and give clarity on what what's being done there. So what are we doing about it? There is increasing requirements in terms of disclosure to make sure as much as possible investors are provided with proper information, with the challenges I mentioned that from the corporate's perspective, the investee companies, it's not always there. And the other one is supervision and enforcement, of course. So it's also for the supervisors when they authorize a product or when they supervise day-to-day that they make sure that that alignment is there. And then one word on ESG, I think it's important what was said. It's not only ratings, you also have data, ESG data, ESG scores. It's all kinds of different products with different angles. And what's important is that the users just understand what it is that they're manipulating and do as they wish. From our engagement with firms, we've seen all kinds of players. Some use it as data points, some rely heavily, some that have their own internal processes with their own full methodology. What's important from our perspective, again, not at all to standardize methodology, but just put the transparency out there and clarity for the users who use it to make the best use depending on their needs.
Mm-hmm.
Natasha, the next question, sorry, John, you want to...
I was just going to say one more thing, and that is about the question about divestment and whether we would divest. So the answer for us is we do not necessarily believe that divestment is the best way to get results from companies. There may be a point at which our engagements raise such concerns with companies that we may decide that we no longer want to be invested in that company. That could happen. More to the point, though, we would actually continue to engage with that company over a period of months and years, even if initially we weren't effective. And what we find sometimes is there's a need to escalate that engagement to bring in more shareholders, for example, filing shareholder proposals, and then even questioning directors if companies really are truly not addressing the risks that we're seeing that they're facing.
Thanks, John. And I would like at that point to ask the organizers if we are allowed to go over time, because we only have now 16 minutes left until we close this session, but we have many interesting questions, and I'm sure that this is going to take a bit longer if we want to address them all. And I have a couple of questions here from me, but I'm going to hold off for now and go to our audience. So for Natasha, but also to the other two speakers, there is a heated debate on ESGs, whether policymakers should step in or instead financial markets should be left alone to take any decisions and self-regulate. What is your view? I mean, the self-regulation sometimes, although it can happen, it is very difficult to be successful, but you are the experts on that one. So Natasha, please go first.
Thanks. It's an excellent question. I think there are two angles to it. The first is, as I mentioned, because of the speed and what we're seeing, there is a very strong concern of investor detriment. And so it's a bit difficult in this type of environment to let self-regulation take place, because there would be a concern that we're not equipped then when something goes wrong to go out and enforce. Whereas here we really are trying. And also, my second response is that in the EU, having 27 jurisdictions, actually, we face problems of potential arbitrage or fragmentation, complexity. And so if we want to help the firms scale up, if we want to make sure that you have fairness in the way different investors are treated across the EU, you need to have common rules. And so to be able to achieve that outcome, we actually need to get together. And this is one of our priorities in our sustainable finance roadmap, is to build capacity and build together convergent views of how this should be done, so we can accompany both the market and protect investors in a consistent way across the single market.
John or Alex, would you like to chime in?
Sure, happy to. I think we need both regulatory action and also voluntary corporate action. So what I find a lot of this debate quite concerning is that it's very one-sided. So you have people like Tariq Fancy saying this is a complete ruse, the sustainable investment industry, you need regulation. But I don't think people in the industry were saying you don't need regulation. I think it's not either or, you can have both and. So there are certain things that regulators are far better placed to do. So if something is quantitative and measurable, then you can regulate it. You can put a minimum wage in, you can put a carbon tax, and then so on. However, there are certain things that you can't regulate because they're not observable, right? So in terms of diversity, yes, you might be able to regulate numbers, but what about inclusion? Can you regulate, create an inclusive corporate culture? You can't measure it. So that's why a lot of my work is on the business case for ESG or diversity inclusion, is that it's in your interest as a company to go beyond just the regulation. Regulation certainly helps, but I also think we want to make sure that it's in companies' interest to want to go beyond the regulation. And so the combination of both voluntary action and government regulation is going to be far greater than what we get from one or the other alone.
Thank you for mentioning inclusion and diversity. We have a question here, which of course I understand the point of view, but at the same time, I do not agree in its principle. It goes, we understand that diversity can be very beneficial. However, at the same time, it can hurt a company. Think of the case where the law dictates a quota for females in the board of directors and you cannot find a qualified female. What happens then? You feel in this position with a not qualified person, and this is going to hurt the company. Of course, it's over to you, Natasha and John and Alex, to respond to that. But first of all, I think that if someone cannot find a qualified woman or man actually, or any gender, as a matter of fact, it's not seeking hard enough. I think there are there's richness in qualification, in education, in degrees out there. So I cannot accept, that argument that there may be someone who's not qualified enough, whatever, gender they belong in. Secondly, I think that sometimes a board can be self-harming because it is averse to change. They do not like, shifting to new realities and the challenges of a new world. And ESGs, although we are all here experts in that field, at the same time, for some people, they're just it's an acronym, all right? And they do not understand or really appreciate the importance of adapting and implementing ESG policies in their companies. So what are your thoughts here? And who would like to go first?
Well, I can take a stab at it. So with regard to board diversity, I think the key is that to achieve a diverse board, sometimes you need to expand the definition of what a qualified board member is. And in fact, there are some folks who believe that the primary benefit of looking for a diverse board is you get a much more diverse set of skills as a result. So back in the day, you had to be a CEO in order to be a board member. But unfortunately, what that meant was the boards were filled with people with very similar qualifications. So in the effort to get more diverse boards of directors, you've had to start to look at people with different kinds of skills and then recognizing the connection between those skills and what the business needs. So that's with regard to board diversity. With regard to workforce diversity, I think the quota is the wrong approach. What is the right approach is an incremental improvement in diversity, a recognition of where the gaps are, what is it within our company that is preventing an inclusive workplace, and an effort to change those factors, to move to a more diverse workforce over time. Remember, turnover only happens so quickly, and so the workforce can only change so quickly. So it's really about going in the right direction than it is to achieve a certain hurdle rate. So I think that's the better way to think about workforce diversity.
Thanks, John. Natasha, any thoughts here?
Just dream of the day where we will ask that question the other way around. And what would we do if we couldn't find a qualified man? Oh my God! And so I really find for me this is not an issue. I think it's just a question of desire, and I'm a very strong believer in diversity and way beyond gender. I think having diverse views around the table creates better outcomes, and it's just something the mindset has to change. And I'm very happy to hear John insisting so much on diversity. For me, that is something that gradually has to come into the culture as a natural thing that firms should do, to go and seek different backgrounds, different profiles, different ethnicities, different everything, so that collectively the outcomes are better. But just obviously we're not there yet.
So I've done a lot of research on this, and I have to say I'm very disappointed by how Elizabeth handled that question. So I think as chair, our goal is to allow challenge and not to impose our own opinions on it and jump to the conclusion that you're absolutely not trying hard enough, not sincere about it. So let's actually look beyond ideology and let's look at the evidence. So what does the evidence find in diversity? This is one of the most celebrated papers on the issue, which is actually when you have diversity, then this actually does reduce firm value. I wish this was not the case. I'm an ethnic minority, I would benefit a lot from diversity, but this is not there. We saw a recent report by the Financial Reporting Council, which claimed that there was a strong business case for diversity. They said they ran all these tests and it was positive. What they actually did is they ran 90 different tests, not a 0-1 was significant. Yet they reported in the executive summary that this found a significant result. And embarrassingly for me, this was a study done by London Business School. So I wish this was not the case, but this was actually what was the case in the data, and people were misrepresenting the results. So why I think this is such a shame is that we don't even need a business case for diversity. Isn't it enough to do it because it's the right thing to do? Right, so there are many things where we think, okay, this is something which does lead to profit and some social outcomes, but it may well be that we think it's just morally right to have a diversity of opinion in the workforce and so on. And why I find this so problematic to have this business case is, what about for the dimensions of diversity that we don't yet have evidence, right? So both John and Natasha talked about other dimensions of diversity. I don't see any evidence that diversity in terms of disability is linked to long-term performance, but that doesn't mean that we don't want to pursue it. So if we are trying to buttress any claim for diversity by saying, oh, look at the evidence, there's studies which show that, I think then there will be really many important dimensions of diversity and inclusion which don't get there. So if the evidence is mixed, and even if there might be sometimes a financial cost, that's not to say that we should do it. Let's just say we're going to do things for the moral and ethical case, not just because we think we're going to be making more money.
Alex, just to clarify, what exactly disappointed you from my point and my argument that there's plenty of talent and plenty of qualification among women out there? So I do not see a shortage of women who are qualified in, equipping boards. What was the argument?
So you conveyed the question. You said you just disagreed with the sentiment of the question. It seems that you didn't want the person to raise that challenge, when the whole point of diversity is we do want to raise the challenge. And in certain cases, it might be the case that you're not able to find somebody who's able to tick every diversity box. Well, if indeed diversity is beyond just gender, have you in certain boards been able to find somebody with a different sexual orientation or different physical disability? Sometimes you're not able to find it. So I don't think it's fair to say you're not looking hard enough because you don't have a disabled gentleman or woman on your board.
Well, we're not here to disagree with each other, of course, but I will say by principle, I think it is absolutely necessary and essential, in the same way that we say that we need to implement ESG principles and, if you like, work with a world which is changing and it's becoming all the more diverse and it has to become more inclusive. In the same fashion, I think it is necessary for boards and for companies to make sure that they look for talent and qualifications in absolutely every corner. Otherwise, they do not have the right HR department in place, or they do not have the right board in place. So let me move to the next question. In relation to the ESG factor, or rather the S&G factor, isn't there the risk that during the process of trying to comply with diversity, you are actually close to discriminating those that are not different, diverse? Who would like to take that first?
I'm sorry, is the question, are they concerned about discrimination against people who have not previously been discriminated against?
Yes, this is what I understand, but let me try to read it again. When it comes to the S&G factor, isn't there the risk that during the process of trying to comply with diversity, so I assume diversity and inclusion, you're actually close to discriminating those that are not different, diverse?
Well, as the sole white male on the panel, I will say that I am not concerned about being discriminated against. I think we are a long way from that becoming a problem. I think that you have to think about this a slightly different way, is that for a long time, white men like myself were given particular privileged positions in the workforce and given opportunities that other people didn't have. What that does, and I actually have, our internal research says that diversity actually does improve corporate performance, but that's an academic debate that will continue, I suppose. Intuitively, though, it's hard to imagine how a workforce that is limited to a certain type of person is not better than one that is inclusive of all, right? Because at the very least, without the inclusion of these other folks, then you're missing talent. Right. So to me, intuitively, this is a reason why diverse workforces are better. They simply have access to more talent. And so now, does that mean necessarily that if I am no longer privileged, then I guess my situation might be slightly worse in a relative sense? And maybe that's true. But what we are trying to do is head towards equality and inclusion. And we are far from a point at which particular kinds of people who have had those privileges in the past now no longer have those privileges and in fact are discriminated against. I just don't see any evidence of that.
Thank you, John. There is another question here which is addressed to Natasha. And John, may I know more about the challenge you faced trying to get reliable and sufficient data on ESG reporting, rating, etc.? For example, where would you usually get ESG related data from? Is it Bloomberg? What kind of data is missing? How bad or poor the data are? And most importantly, how would you imagine the perfect workflow for getting those reliable data? And these are for Natasha and John. Natasha, would you like to go first, and then John?
Okay, I'm happy to kick off. So I hope I was not misunderstood to say that I have a silver bullet and I know exactly what information should be done for everyone. On the contrary, I think only firms know precisely, depending on their particular case, depending on their business model, on their operations, exactly what is the right data to communicate on their commitment and on their journey. What we're saying, what's a bit problematic today is in this transformation period, there is an expectation, a need for data, because people like John and others, they want to know, but we're not there yet. We haven't provided, as regulators, clear standards on how you communicate on some of these information. We haven't communicated harmonized view on what's expected, and the firms have not fully done their own journey. So we are in this space in the middle where stakeholders who are interested need to find by their own means some of that information. So in some cases, like gas emissions, some things are much more standardized, in other areas less so. So all we're saying is it's very important for the value chain to be robust, to be able to provide that information for stakeholders to make their own judgment at the end of the day. And we, as regulators, want to provide and contribute to make sure we can provide proper guidance so that when firms think about, okay, I want to communicate on my E, my S, or my G factor in the EU, that there is some consistency in how it's done. And so there's a lot of work going on from a corporate reporting perspective. So we provide that guidance, and hopefully that will come into play in the coming years, hopefully very quickly. But we're doing what was done in the financial statements, financial reporting segment in a much more streamlined and short period of time. So very challenging, and we're trying to do it internationally, which makes it even more complex. But that's what we're saying. So there's no problem. We're not criticizing anybody per se. We're just in that space in a transition that makes it very challenging.
Okay. Elizabeth, you're on mute. Yeah.
Yes.
Well, I was going to say, I mean, it's a tough question for me to answer because we have a couple of dozen people at Calvert who are employed full time in trying to answer that question. So what we have is, we have a lot of data sources now. There are a lot of companies that are providing different kinds of ESG data to us. And a big part of our job is to look at all of that data, review it, and do kind of an analysis that helps us understand which data point correlate to corporate outcomes. So what are the most material factors for companies? Which data points help us to best understand those? That is an ongoing project at Calvert. And so we are a big consumer of information, but the analysis of that information is where we add value. And so what we try to do is to find those data points that seem to correlate most closely to the outcomes that we're seeking, which is both financial and impact. And so that is an ongoing project. Again, I can tell you 10 years ago, there wasn't even a fraction of the data available. Today, you have a cacophony of so many data points, which creates a lot of work for us. Hopefully in the future, then we will eventually settle on things that are more universally accepted or credible as data sources. And I think that's a long-term project. I would point out that even financial information contains an awful lot of subjectivity. So we may never get to that point with ESG information, but financial information has about a 500-year head start on us. So we're on a journey, and I think we've come a long way.
Thank you, John. And I would like to thank you all because we have to leave it here. I'm afraid we ran out of time, but I think it was a tremendously insightful conversation here with a lot of engagement from the audience. With some closing remarks from me, a company, I think, has to live and breathe purpose and make it part of its DNA. I think that embedding the idea of values-driven businesses in practice, it does not take a single form. It does not rely on one single characteristic. It's more of an embedding, different elements like ethical thinking, kindness, which is very important in our world today, respect, accountability, and that has to be a personal leadership strategy, and of course, an individual discipline and practice. And this is the only way ahead for our world and for the future of our societies. Otherwise, we will face dire consequences. I would like once again to thank the Institute for giving us the opportunity to have this conversation, and EBRD, of course, and looking forward to crossing paths with all of you again in the future, and keep up whatever you're doing towards implementing this ESG mentality. Thank you.
Thank you, everyone.
Thanks.
Thank you very much, Elizabeth, and thank you very much, Alex, Natasha, and John, for this very insightful discussion, and for sharing your views. ESG is a quite heated sort of speaking area, so any debates are always, not necessarily agree, but I'm sure that the audience enjoyed this panel. So once again, thank you so much.